Hey guys, Bix Weir, is the end of the holiday here in America, MLK Day. Happy MLK Day. So there was no repos today, but it's getting interesting. The more I dive into the repo market and what happened at the end of the year, why it didn't crash, it became apparent that there was a backdoor bailout. Now this is from the Office of Financial Research .gov, the Money Market Monitor Fund or page, U.S. investments, repos. So we have three types: the Treasury Repurchase Agreement, government agency like mortgage-backed securities, and other. As you can tell from the chart here, the big one is the Treasury Repurchase. And this market, Treasury market, now this would be December 31st. It's day specific. We're going to see how much was put in and who put it in. So the Treasury repos, 800 billion, government agencies 0.4, and other 0.1. So if you go over here on the left and you click details for the Treasury and you hit drill down, these are all the entities, and you can see what happened here. This is December 31st. This monster orange line, what could that be? The FICC. Now, what is the FICC? It's owned by the DTCC, the same Depository Clearing and Trust Corporation that I've been screaming about for so long. It's supposed to be where all the trades are settled. And instead, they are a counterparty. At the end of the year, if you look at what the FICC put into the repo market, in November it was 141, in December 278 billion. So Zoltan Pozar, if you're looking for where it came from, FICC. But FICC, I don't even know if they hold it. Why? Because if you drill down into the FICC details, it's a bunch of banks that are running the book for them, or they are having the FICC take the credit risk to cook their books. Yes, it's very crazy. And I got this from this couple who does great work, by the way, Wall Street on Parade, Pam Martins and Russ Martins. They go through some of this stuff, but really, you go to this website, and it shows not only, and it's on both of them. So, but you look in the details and you drill down to the details of just the treasuries. JP Morgan is here, right? Royal Bank of Canada is huge. JP. $28 billion is what JP Morgan says they contributed, and the Fed hardly contributed anything. This is the one we've been looking at, the $47 billion. The FICC put in $278 billion. So what really is going on? JP Morgan at 28, was JP Morgan just at 28? Not according to the FICC. Drill down, and you see right here, bang, another $46 billion for JP Morgan, but they have the FICC covering them because they're supposed to be, this is a problem with collateral. The FICC, which is the DTCC, is supposed to be clearing all these trades. Nobody knows who owns these treasuries anymore because the DTCC can't do its job. That's the problem. We need a new system of trading capital assets back and forth. Something that is verifiable, so there's not mass rehypothecation, which I think is going on. So JP Morgan on the Treasury side has basically two hidden, one not hidden, and one hidden under FICC, probably just a guarantee. The FICC doesn't even know whose they are, and that's their job. So really interesting stuff when you take a dive into this website, financialresearch.gov. As you can tell, look at that orange line. Just a monster. If you want to know who bailed out the banks, it was the DTCC. And the DTCC, I don't even think they own it. Truthfully, I think they're just lending their name to cover up for the banksters who really don't know what's going on behind the scenes. Completely screwed. Good Wall Street Journal article. Global banks push back into repo markets. Increased dependence comes as growth among the main shadow banking funding sources has slowed. Global banks use funding from markets rather than from customer deposits. Let me read that again. Global banks use of funding from markets rather than customer deposits has grown rapidly in recent years, mostly in the form of short-term funding, which is a central problem of the 2008 financial crisis, according to the body that monitors global financial risk. However, that growing use has been spread unevenly around the globe. Banks in the US, UK, and Canada have become among the biggest lenders into short-term financing markets, while banks in France and Japan are now the biggest borrowers after rapid growth in these markets in 2017-2018. Short-term funding is risky because it can suddenly disappear when lenders, typically money market funds, fund managers, and cash-rich banks, get concerned about the credit worthiness of borrowers, who can then be forced to fire sale an asset if the lenders pull back. And that's what happened on September. It really happened on September 11th, but it didn't show into the markets until September 17th when the repo rate jumped to 10%. So they are fixing the problem by using the DTCC as cover through the FICC. It's ugly. And remember, short-term, this is the cheapest money out there, the short-term money. Who uses it? It goes through JP Morgan to hedge funds and other leveraged investment banks, money managers, you name it. They're leveraging it up to the hilt, like 100 to 1. But they're going through JP Morgan. Now JP Morgan's scared about the risk, so what do? They pawn it over to the FICC. The FICC is the one taking the credit risk for JP Morgan and friends, which this chart shows very clearly. Look, the FICC wasn't even in the market before right around here, 2018. Nothing. Everybody thought the system would crash before that. It's the FICC that's bailing these people out with phony credit because nobody knows who the owners are anymore of any of this stuff. It's all supposed to be recorded at the DTCC, which is the FICC is a subsidiary of the DTCC. That's the whole problem. Behind the scenes, it is a fraud. And nobody trusts the collateral anymore. So what did the banks do? They said, it's going to blow up unless you take our credit risk. For December 31st, bang, right there, $278 billion out of the FICC. And then you dig in farther into the FICC, and you find out who was it that turned to the FICC for credit saving. JP Morgan Chase, $47 billion. Fidelity, $40.8 billion. Who's this big one? Holy crap, BlackRock. I keep telling you guys, keep an eye on BlackRock. The BlackRock name, it's really a dark operation. Absolutely. They're knee-deep in the criminality and silver as well. Keep an eye on BlackRock. They get away with a hell of a lot more than a regulated bank gets away with. Wells Fargo, Goldman Sachs, all the names we all know and love to hate. Morgan Stanley. This is the derivative bubble that is going to blow. But that's what's happening. These banks are like, I can't take the credit risk. The regulators won't let me. The FICC comes in and says, we'll cover it. We'll basically give you a guarantee. We'll do the repo loan with your assets. There you go. There's your weekend update. The craziness around the world. I do keep track of this at the Road to Ruta, but I need to start keeping track of what the FICC is doing because that's not included in the Fed data. All I'm looking at is the Fed stuff right here. That little one, the little Federal Reserve. It's the FICC that's making the major bailouts now. See that? This is the Fed part. $47.4 billion. This is the FICC, $278.6 billion. And it is basically, it's a cover. The FICC is saying we are the credit, and the banks can say, nope, it wasn't us. We're still within compliance of all the new regulations. That's how fraud happens, my friends. And that's what's happening right now. Anyway, you want to keep up on this, go to roadtoroota.com. I got all kinds of things on the private road these days. It's getting better and better. Will Trump silver skewer Jamie Dimon today? That was about the Jamie Dimon met with Trump right after their earnings. I would love to be a fly on the wall on that one. Hey, Jamie, you play ball with us or we're going to unleash the RICO charges and include you and Blythe Masters, which I think they will at some point. I'm hoping. We're all hoping that these criminals go away. Anyway, that's it. Hang tough. We're going to have new repos tomorrow. I'll talk to you later.